Welcome to another episode of Real Estate Unfiltered with Bridget
and Angie.
And today, what are we talking about?
Lingo. The wonderful world of lingo. I feel like in most professions, well, I think every profession has their own terminology. And I feel like in the real estate, on my end and your end, it can be kind of confusing because two words can mean the same thing.
Right.
So I think they have different meanings, but they end up essentially becoming the same thing. So for example, when it comes to when a borrower wants to get approved for a loan, they get a pre-qualification or they get a pre-approval.
What's the difference? Because I don't think they're the same, are they?
They're not.
Okay.
So they're based on levels of how much has actually already been verified on the borrower. So when I think of a pre-qualification, I think of like those credit card mailers you get in the mail that says you've been pre-approved for a $50,000 credit card through American Express or whatever. Like they don't know anything about you. It is based on your credit history that says, oh yeah, you're approved for this credit card. Here's 50 grand in credit cards, But so they don't actually truly verify. It's that same thing with the pre-qualification. You can go online, say, okay, I make 100 grand a year. I want to buy a house. Am I approved? It says, yep, you're good to go. But the robots didn't verify any of your stuff. Like you could have no job. You could have lied. You could say that you make 100 grand a year, but you're self-employed and you walk your dog for a living. Like, you know what I mean?
So I can't cash those big checks they send me.
Right. So essentially, yeah, they may have like looked at your credit. I'm assuming they do like a soft pull or something, but it's not an actual approval. So you want a pre-approval at least to show that whoever you're working with, they verified your income, your assets, and your credit. Those are the three key components to any approval when it comes to if you can qualify for a mortgage. So those are critical to verify because you want to make sure, because as we talked about in episodes prior, not all income is calculated the same.
Correct.
And if you have a brand new job or you just open up your own business, I mean, that changes your qualification for a loan. So you want your lender to verify what your actual qualifying income is.
So you said a soft pull.
Yeah.
What is that? What does that mean?
So a soft pull versus a hard pull. So a soft pull is like we look at your credit without actually like pulling it directly from the credit bureaus. So we do a soft pull on it. So we take a look. We don't like dig in. So a soft pull is great because it does not impact your credit score. So, and that's really, important for people who are just starting their home process, like shopping process, because your credit report expires in 4 months. And the last thing you want to do is keep on doing a hard pull on credit every single time, because when you do a hard pull, it dings your credit. Right. So doing a soft pull also works good for borrowers who are rebuilding credit. So that way, if they're working to rebuild their score, we're not dinging. It's not a permanent decrease on credit, but it's still a ding on your credit. So it's like when you go buy a car, they pull your credit 15 times, for all the different lenders that they can go through, and every single one of them puts up in a credit report.
Yep.
Like every single one of them. I mean, so that hard pull is not 15 individuals. Hard pulls, they do combine them together as one, similar to like for a mortgage. So if whomever you're working with does not offer a soft pull and they do a hard pull, you have, some say 15 days, some say 30 days. I just say keep it within like a 15-day window or a 2-week window where you can shop around for a mortgage and it won't continuously ding it because it groups it together. Because your credit reports, your credit pulls are categorized. So yours for a mortgage, it will say home loan. Car loan says auto. So it categorizes what those pulls are for. But when you do a pre-approval, we only do soft pulls. I only do soft pulls. I think maybe other people operate differently. But a lot of my clients that I work with are a lot of them that are in the credit building stages of their financial home buying journey. So we do soft pulls and they do a hard pull once you find an actual house.
Okay. So when a client comes to you and they want to buy a house, like, do you pre-qualify them or do you pre-approve them?
I pre-approve them.
And now you have different levels.
Yes. And then I level up that pre-approval even more, usually, well, almost always for every government loan.
Okay.
So FHA, VA, USDA, I have those go through a physical underwriter, only because when sellers, from what I've understood, sellers, when they get a pre-approval letter for a government-backed loan, they are immediately turned off.
Correct.
So they have, there's like this preconceived notion that government loans are bad, that the borrowers are bad. They have bad credit, they have bad income, they can't afford the house. Like all of those are very much wrong. FHA loans, VA loans, US, I mean, those are all specific loans that work perfectly for the right person.
Absolutely.
And it's not to say that they're any worse off buying a house than somebody who makes $1 million a year. I mean, somebody who makes a lot of money can also be in a government loan. It really depends on their current situation. So when I take those loans and I put them through like a direct, like our physical underwriter at our company actually underwrites that loan as if it was going to be going in like with a contract.
Okay.
As if they were going through the whole process, getting the loan commitment, all that kind of stuff. They verify. We do verification of a claim. We call the employer. We get all that. We get the bank statements. We do a complete underwrite on their loan, and then you get a new letter that says your loan has been formally underwritten and approved by an underwriter, and that helps take away, I think, one of the biggest fears. I'm assuming, I'm hoping.
Yeah, absolutely. Knowing a client is fully underwritten.
Yeah,
it is good because really then there's not too many hurdles,
right?
In terms of lending. So
yeah, it's more the house then.
Correct.
Getting through the appraisal and the inspection part of it. And we can do that in conventional loans also. I had one go through that was going to be a WIDA loan, which is considered a conventional loan. But it's always better to have that security, and then it shows you're fully underwritten. And then if it is like a multiple offer situation, if you come in with a fully underwritten approval, I mean, that's going to stand a lot stronger than somebody who doesn't have that.
Yeah, I just had first-time home buyers that were in a bidding war, and I was able to supply the pre-approval that was fully underwritten, and I explained that to the agent, and their offer got selected. It absolutely does help. So yeah, I mean, so you definitely want to go to that third tier.
Yeah.
So
it doesn't take that much longer to do either. Like one of my clients that I'm working with, their lender that they had before me said that it was going to take them a week to get them a pre-approval. I said, why would it take you a week to do a pre-approval? Like sometimes I guess I can see if there's like some gray area you need to like work through some things, but it still shouldn't take you a week to, or at least if you're working with them through it, then they know that's taking a little bit longer. But if you don't hear anything from them for a week, like why is it taking you so long? Like if we have it go through an actual underwriter, it only takes usually like 24-ish hours for our processors to get their loan ready, and then like 24 to 40 hours for the underwriter to actually review it.
Okay.
I mean, so I don't understand why it would take a lot. I mean, I guess everybody,
especially nowadays, things just seem to be so much faster.
Yeah.
And I think that's good to point out that because I get a lot of times buyers like, oh yeah, well we kind of know our budget. We filled out information online.
So pre-qualification.
That's correct. Yes. So if you get a pre-approval or pre-qualification online within 20 minutes or less, it's not a solid
correct
document. Yeah. You actually want to talk to a lender. And so if somebody wants to get pre-approved, and that takes roughly about, what'd you say, like 24 hours
Usually
or so?
20, because if we don't need to get underwriting involved, 24 hours. Yeah. As long as you give me documents. That's the biggest thing. We need documents.
Yeah. You're going to need those documents.
So that's going to fall on the borrower on how quick they get them to you. But most people, if they're actively shopping, we usually get them like immediately. Because once they hit submit on the online thing, it asks them, okay, now we need to get, pay stubs, W-2s, bank statements if you're self-employed, tax returns. So it spits out secure folders immediately for them to start uploading things in. So usually they're within 24 hours. And I have Taylor, my assistant, that helps, work those as well.
Right. Yeah. And you definitely want to be pre-approved, not pre-qualified.
Correct.
When shopping for a home, because sellers, they won't entertain an offer without a pre-approval. So you definitely want to make sure that, you start that process before you submit an offer. And most agents do ask, are you pre-approved? So
yeah. So again, three things that mean the same thing, but they're different.
They're different.
Yeah.
Okay.
Yeah.
What is another one that you have?
I feel like I get this a lot, the difference between a home inspection and an appraisal.
Yes. And I even hear that too, because I'll have buyers say, well, we have to do a home inspection, right? No. You don't have to do a home inspection.
No.
Is it advised? Absolutely. You should know what you're buying, but you don't have to do one if you don't want one.
Correct. But an appraisal, more often than not, is going to be required. There's a couple of instances where an appraisal can get waived depending on, how much you're putting down, the market you're buying in. But a lot of homes require appraisals. Mm-hmm. And that's something that we as a lender take care of. We do not order home inspections.
Correct.
So if somebody's going to get a home inspection done, it is on themselves and or the agent to find somebody to do it, to schedule it, pay for it, and then negotiate through it when that is done. We just take care of the appraisal side of it.
Right.
And then if somebody has a government-backed loan, there's a misconception that, so FHA, we talked about this many times before, FHA does a health and safety inspection. That is not a home inspection. So the health and safety inspection is verifying the health and safety of the home and the occupants in that home. Like we did an episode a couple of weeks ago talking about, why lead-based paint is a big issue, when it comes to health and safety of a house, and why that's required to be fixed. So those are different than the appraisal and the home inspection. So again, it's all things inspecting the home, but a home inspector is essentially like a house doctor. Basically.
Yeah. I mean, absolutely. Yeah. Because they're going to pick out things. A home inspection is going to point out things that a health and safety inspection, which is done by an appraiser,
right,
is looking for other things within government-backed loan guidelines.
Yes.
So, and that, that goes for FHA, VA, USDA, and does WIDA?
That's it. No, WIDA's conventional.
Okay.
Yeah.
Yep. So, I mean, those are the difference.
Yeah.
So.
Yeah, and usually if you do a home inspection, they find those. It's best to get those things remedied before you order the appraisal, because if you do like a government-backed loan and they note those things, you have to pay a reinspection fee. Then you have to fix those.
Exactly.
So that's why it's important to do a home inspection and then take care of the things that are noted on there, because I'm assuming they flag some of the things that say, hey, this won't pass FHA. Mm-hmm.
Yep. Same goes for VA. I've worked with a lot of FHA and VAs, so I'm very familiar with how they work and things that they're going to flag. So even when I list a home, I can point stuff out like, hey, this is probably going to get flagged. This should be okay. And then I kind of leave it up to the seller. Like, do we want to address them now, or do we want to wait and see what type of loan, a buyer brings? Because these are the things that will need to be addressed.
Yeah.
So.
Yeah. And there's one thing that every seller should be aware of is every home has to have carbon monoxide and smoke detectors on all levels of the house. And that has been flagged on conventional loans also. So
yes, that blew my mind.
Yeah. And that took me, I was like, wait, what? Like I even fought back on that. And they said, no, that is it. I pulled it up. It really is. It's required. You have to have those.
That happened to you and I. And I think that was the first time
we learned about it. Yeah.
That's when we did. I'm like, Angie, why is the appraiser flagging?
That's I think my first time getting a conventional loan comeback subject to is like,
I was like, what? This is conventional. So yeah.
So that's something I tell everybody, and I'm sure you tell everybody too, is that has to be on every floor of the home, and they have to be working. They can't just be there, not plugged in or have dead batteries in them.
Yep.
So that is a requirement, and that will get flagged on all loans.
Yeah, which is, I mean, it's great, but it's just crazy to know that now conventional does require that. So.
Yeah, so that's just following the thing. But it's important to know that a health and safety inspection is not a home inspection. Like they don't go as in detail as a home inspector does. It is included in with your FHA appraisal or your VA appraisal. They do it. It's all in one, not multiple inspections. But yeah, those are not the same thing. And home inspection is 100% on the buyer.
Yeah, absolutely. So what other? I know I have one. Which is on the lending side, that gets misconstrued even by agents.
Is this the hot topic one that I get a phone call from? Like,
I mean, I knew the answer, but I'm like, after I explained in detail to the agent the difference, I did call you, and I'm like, this is what just happened. Was I right? I'm pretty sure. I'm like 99.9% sure.
This makes me think of, if you ever watched Family Guy, when Peter Griffin has his episode on TV, is like, what really grinds my gears?
I've never watched that.
You gotta watch that one. He has his own little TV segment that goes, really grinds my gears, and he goes off about all his random stuff.
We should do an episode about that.
Yeah.
I've got
Yeah.
A few.
The gear grinder episode.
Yeah. The difference between loan commitment and clear to close, those are not the same, but in the long run, they mean the same.
Correct. Yeah. So loan commitment, I guess it depends on how each person words it too. I feel like there's different words for the same thing. Loan commitment, essentially, how I view it is you have underwritten approval. Kind of like when you do the full underwriting of a pre-approval. You know, you have underwritten, has reviewed your file, you are approved based on, appraisal, title, just some of the basic things. So if it comes back with like the basic conditions, which are usually going to be appraisal, title, and homeowners insurance are usually the most common ones, and maybe even like the earnest money receipt, which you got to talk about earnest money too. If those are the standard conditions, I mean, at that point, your loan is pretty much good to go,
right?
Unless the house fails appraisal,
right?
Or something crazy comes up on title that you have no control over. So, I mean, those are the things. So, essentially, that is loan commitment, that your loan has been approved by an underwriter. Now, clear to close, sometimes those two can come at the same time, because sometimes if everything is in the file, we have a little bit of leeway on those contingency dates. We'll issue a loan commitment with the clear to close, that when you get that letter from the buyer or from the borrower, it will have no conditions on it. So approval from underwriting comes back as we call it a conditional approval. So it's approved with conditions. Which essentially, again, is saying the loan is approved.
Correct.
And then clear to close is when all of those conditions have been satisfied, and now your file moves from underwriting over to the closing team, and then they work with all the closing docs. So that's the distinctions between those. So I can see why agents would want the clear to close, because then the loan is literally done.
Right, but according to the offer to purchase, in there, one of the contingencies is loan commitment.
Yeah.
Okay. And usually those do have the conditions, and they're just minor, final little details that need to be cleared up.
If there's anything major, then you won't issue it.
Right. Yeah. Exactly. So a loan commitment is something that needs to be submitted to your agent as soon as you get it, because you have to stick within the contract, the dates and deadlines.
Yeah. And fun fact, in the contract, the loan commitment has to come from the borrower.
Yes.
It cannot come from the lender. It says it in the contract that it is not considered valid if it comes from the lender.
Correct. Yes. So any of you buyers out there, when your lender sends you your loan commitment, get it to your agent immediately.
Yeah, it has to come from the buyer. Do you know why? Why does that matter?
No, I don't know why it matters, because, you guys can tell me, or us agents, when appraisals are good.
Yeah. So I don't understand why we can't give you a loan commitment.
I don't either.
I think that just changed too, and they changed the offer to purchase a few years ago. So they just changed that verbiage on it, because we had in my previous employer, we had a training class on the new offer to purchase. That probably was 5 years ago. I think they added that in there. I just was surprised. I didn't know why that was. Why that matters.
From what I understand is because we take the loan commitment as buyer's agents, right? We get the loan commitment, and then we have to forward them on to the listing agent. So I think maybe if it's coming from the borrower to me, that's them giving me permission to share it.
Okay. That makes sense, because the appraisal cannot be shared. That makes sense.
Yeah. So that
I think coming directly from, quote unquote, the horse's mouth, you would think it would be it's coming from the lender, but
yeah. So then, we've got that little extra step, and believe it or not, some buyers forget to give loan commitment. So I'm always checking on that. I'll reach out to the lender and say, hey, do you have loan commitment? And you'll say, yeah, I just emailed it to the borrower 10 minutes ago or an hour ago.
Yeah.
And so then my next step is then I email or call the buyer.
Yeah, hey, and I always say in my email that says, this is your loan commitment, please review and then forward to your agent. They need to have this in the file for your offer to purchase contingencies. You have to give it to them.
Correct. Yes, we do need it.
Yeah.
And I've even had agents that missed loan commitment, the contingency, because he said it wasn't
clear to close.
He wasn't clear to close. He needed a clear to close, and he did not get me the loan commitment. And I'm like, I need the loan commitment per the offer you submitted. I don't need clear to close. I don't need
We
that.
love clear to close.
We would,
Yeah.
but yeah, according to the offer to purchase, loan commitment.
Yeah, because sometimes clear to close, depending on whatever is going on the background, it does not happen until maybe the day before or even the day of. I mean, who knows? Because I've had it before where we are on a tight deadline, with things that the borrower has to do or whichever, and then we disclose that to like, hey, we're good to go pending this is resolved.
Right.
That way everybody's aware of what's going on, but that way you're not missing your commitment dates.
Correct.
But because sometimes we would like it to come ahead of time, but sometimes every file is different.
Right. Yeah. So cleared or loan commitment, then clear to close.
Yeah.
So, and clear to close is not in the offer to purchase.
No.
So
that's basically the closing date. Yeah. The clear to close is basically
exactly. Exactly. So yes, loan commitment is needed first. Yeah. So yeah, that's another one that, they essentially mean the same thing, but
right.
They're a little different. I know on my end, earnest money.
Yeah. So going back to earnest money versus down payment.
Down payment. I get that a lot. When I'm going to write an offer with a buyer, we're going through, I'm asking, what they want to offer, closing date, just all of that information. And then I get to earnest money. How much do you want to put down? And I get, well, is that the down payment?
Or they say, what is it? You ever get that?
Yes. Yeah. They're not sure what it means. Yeah. It's either, I don't really know what that means, or is that the down payment?
Yeah.
So essentially, again, kind of the same thing, but yet different.
Because they feed into each other.
Correct.
In the end.
Yes. Absolutely. Yep. So earnest money is good faith money that you are putting down on the home that you're purchasing to state that you're serious and this is the home that you're wanting.
You're not going to walk away mid-contract.
Correct.
Yeah.
Correct. Yeah. And it's kind of something that the seller can hold on to, knowing that you're not going to back out, but it doesn't go to the seller.
Right. Because the seller does not get that money. You're not paying the seller,
right.
to hold the house.
Right. But it's something the seller, is obviously
their
aware
agent
of.
or the title company. Yeah.
Right. Yep. Absolutely. So when you submit earnest money, that is different than your down payment. The earnest money is due typically within 3 to 5 days of an accepted offer. And that you can, pay check, you can use wire, like a transfer funds, you can, do it that way.
I had somebody paid the earnest money in cash. I know we needed to ask for earnest money receipt. They sent me a photocopy of all of the $100 bills on the photocopy. It was like they sent me an image of the. I never had that before, but somebody paid it in cash and they photocopied all of the cash as their proof of funds for their earnest money. I mean, you can't use that because cash is not a valid source for verified funds. But I thought, I have never had that before. I was like, isn't it illegal to photocopy money? I mean, you can't use it, but
right.
I don't know. I've never had that where it's like literally the money's like fanned out, like $500 or whatever. It's like fanned out with the receipt.
That's hilarious. Yeah. No. So the earnest money that you put down, again, it's due, whatever your agent puts in or whatever you're comfortable with within 3 to 5 days of an accepted offer. And that gets held either at a title company or the listing agent's trust account. Yeah. So it doesn't actually go to the seller. It can go to the seller if you get cold feet and decide to walk. They have every right to fight for that earnest money.
If you break contract.
Yeah, exactly. Yeah. But if, you're dealing with an inspection or financing and that falls through, 9 times out of 10, you can get your earnest money back. You can say, hey, it's coming back because we didn't, agree to the terms.
Right. One of the contract agencies was not met.
Exactly. So then you can. Yep.
But it's important to know that when you pay earnest money, that check is cashed. It is not just sitting, where they just give you that check back at closing. They do cash that check to make sure you have the assets to cover whatever you are going to be putting down because they do cash that check.
Yes, absolutely.
And then we as a lender verify where those assets came from too. So again, cash, not so much, but we do verify that. And then because we verify it where it came because it comes back to you. So if everything is good to go, we get to the closing table, whatever you put down for earnest money, then comes back to you at closing and is applied towards your down payment. So that's probably why people think it may be part of it, because it is applied back towards, I mean, it's applied back towards like your cash to close as a whole. Honestly, but it does come back to you. If everything on the contract is met, everything is going to be closed. Whatever you put down comes back to you.
Correct. Yes. Yeah, that's exactly it. You're good to go. You close. That money then gets kind of taken off the total that you need to bring.
So it's kind of like a security deposit.
Right. Exactly.
Like when you go to rent an apartment or something, you put a security deposit. Or when you go to a hotel, you put a security deposit down.
Exactly. So yeah, that's another good way to look at it.
Yeah.
But it gives the seller confidence that good, they're serious. And it's something that they, kind of can mentally hold on to, that it's, serious and it's written in the contract and stuff. So, but yes, it does get applied towards the closing costs, down payment, money to bring. At the end.
Yeah.
So it's not just money that goes to the sellers to go on a shopping spree.
Right. It's not, not play money for them. It's just, saying that you're serious. And if you break the contract for any reason, you could forfeit that money. So
correct.
Make sure you don't put earnest money at $50,000 and then
break
the contract.
Exactly. And then decide, I'm not quite sure about this house anymore.
Yeah. Doesn't quite work that way. And sellers, I mean, it is a legally binding contract. So if things are broken outside of the contract, I mean, there could be legal ramifications.
Absolutely.
So it's not to be taken lightly.
No, absolutely. It is not to be taken lightly.
Yeah.
So,
and then feeding into that, so then we talk about closing, we have the ICD and we have the CD. And then you have the ALTA. So we have all these different things. So CD is closing disclosure. That is what you get at the very end. In the beginning, you get the loan estimate, where it's literally an estimate of all the fees for title, appraisal, all of the fees on there. Again, all estimates. We don't know what anything is. And then once everything goes through the process, we get all the invoices, everything from everybody. Then the closing disclosure, the CD, has more of like the fine-tuned numbers, a little bit more accurate of numbers. Now we issue an ICD, which is an initial closing disclosure, which is sent out to borrowers at least 3 business days. Business days is an important part of it prior to closing, so that it excludes Sundays and holidays. Saturday is considered a business day,
which is crazy now that it's a business day. It used to be not a business day.
And I'm okay with that because it makes my job a little bit easier. But Sundays and holidays are not business days, and that can really throw a wrench in your timeline when like you have a holiday in the middle of the week. I mean, it really, and some of you I even forget about. Like, oh crap! Like President's Day is a holiday. It's like you think of Christmas and Thanksgiving, and then some of the other ones too. You got President's Day, so you didn't think of those. But the initial closing disclosure is required to be sent out to the borrower at least 3 business days prior to closing, and is required to be signed. So the initial closing disclosure, usually depending on how everything is going, we try and get that fine-tuned to make it as close to accurate as possible, pending maybe some final numbers from title that they need to get from the seller for, septic or water or whatever.
Yeah, final water reading, septic.
So little things like that. So we try and get as close to accurate as possible. If not, we say, hey, this is not going to be 100% accurate. But look it over, and if anything looks incorrect, like I just had one that you and I just closed where they missed the amendment for the seller credit. They never got a copy of it. So I said, we're short by this much for the seller credit. And they said, oh, we never got that amendment. So the initial close disclosure is really great to find any discrepancies or errors. But it's called the ICD. And then the CD is a final CD that the borrower signs at closing. And that's what their final numbers are drawn up on. And both of those, you should see the earnest money. You used to go look credit line on there for earnest money. But then as agents, you have a different one.
Correct. I mean, it does have some of your lender fees in there. But what we get is the preliminary ALTA that gets sent to us agents. We look it over to make sure everything is correct. And then I always pass it along to buyer or seller, whoever I happen to have, and also have you guys double check, because we've caught it where the payoff wasn't on there for a loan. And so the seller was due to get back a really big amount. And they're like, hey, my loan's not on here. So then you have to go back. And that's your time to kind of go through it, make sure everything's correct. And if it is perfect, usually, like it's an estimate,
Right.
because they have to do final water reading. They have to get final numbers from the lender, if something needs to be added in or taken out. So the preliminary numbers are estimates. You will get the Ulta final numbers at the end, at the closing table.
And the borrower gets both. So you
Yes.
as a borrower get both. You get the lender closing disclosure and you get the title company's closing disclosure. In my opinion, the title company one is way easier to read because everything is all on one page versus ours. It shows all of your stuff and then it has the seller stuff on the bottom, like we see like the credits for anything. But it's so the Ulta is, in my opinion, a lot easier to read, but it shows the exact same thing.
Right.
It shows how it's laid out.
And they do verify that at the title company when you're closing too. They're like, this is the exact same numbers, just laid out differently. We just need to make sure that the two bottom lines match in terms of numbers. So
yeah, so that's an important one. But yeah, there's a distinction between the two, but again, they do the same thing.
Yep, absolutely. Kind of like red.
Oh yeah, like how different words can mean different things.
Read as in the color, or you read a book.
Yeah,
same thing.
So it's always interesting. Like I remember a couple years ago, I made a mortgage bingo lingo. I did it for at my old company, just to engage the team, just to teach people, because I didn't know a lot of terms when it comes to mortgage until I got into the industry, and I'm still learning things. Like you and I learned things together too. Like that, what was it, FVA, the future value assessment, like. Yeah. So it's like
I was like, wait, what's FVA? And I called you, and you were like, I don't know. And
so it's future value assessment or something like that, where I'm assuming it's linked to like a renovation loan, where it's like the future value of whatever they're going to do to the house. But I made a mortgage bingo lingo card because it also sounds fun. I mean, bingo lingo. But there's 25 squares in a bingo card, and I had like 30. Like you don't think of like FHA as an acronym, VA as an acronym. People know what they mean, but they're acronyms,
right? Absolutely.
So there's so many different lingos. So it's also trying to remember to break it down. Like when we say ICD, it's like, what is that? So usually I'll say, your initial closing disclosure is coming to you.
Yep.
We just talk in lingo, with our teams because it's
it's a lot easier. Yeah. Typing wise too. Yeah. Same thing. We've got a whole bunch of lingo, which I don't necessarily use as much with clients. That's more like on the back end from agent to agent, OTP.
Yeah, the offer to purchase.
Yep. But I don't, tell the clients, okay, I'm going to go do your OTP.
Yeah, you know me.
That is. Maybe I'm going to start saying that and then adding in a little dance.
Yeah, you know me.
OTP.
Oh, we date ourselves, Anyways, I had one where it's not really a lingo, but I had a borrower. She called me. She's like, "Hey, I got these documents in the mail that I need to sign. When can I drop them off for you?" I said, "You should need to sign anything because everything we do in the beginning is all DocuSign.
Yeah.
Like, we don't have anything that you actually need to like physically sign. So you come to the closing table where it needs to be wet signed."
Oh yes, yeah.
And she's like, "What?" I was like, "Wet sign?" She's like, "I've never heard of wet sign before."
Yeah.
I was like, "So that's basically like pen to paper, like when you are physically signing it versus electronically signing it, like a digital signature." Like, I have never heard of a wet sign before.
I have. And when I, explain to some of my buyers that, they're not very tech savvy. So I'll have them come in to sign, and I'll either say wet sign but mostly I say physically sign.
Yeah.
So yeah.
Yeah. But she's like, "I never heard that term before." Like, really? I guess I never thought of that. It's not really a lingo, but I get it. Like, wet sign, like, what does that mean? Like,
right. Yeah.
But that's sign. Literally pen to paper. So you're physically signing it versus electronically signing it.
Right. Yeah.
But I've always used that. I never had anybody say that. I was like, oh, I guess I never thought of that before.
Yeah, I haven't either. And that's a weird way to say sign, physically sign.
Yeah.
Wet.
But I always say wet sign. But I think it's because like in our guidelines, it says wet sign. Like it says that like this, like only like certain documents cannot be DocuSigned. Like you have to wet sign them. So it says it in like our guidelines on what you can and can't DocuSign. So maybe it's just because I've read it so many times and I'm just used to it. But I guess it's one of the things you don't, I don't know.
Yeah, I say physically sign, or digitally sign, send it to you,
DocuSign, which is electronic signature.
Yeah, electronic. So yeah, I mean, there's a different couple of ways you could say either one of them.
Yeah. I thought that was fascinating, like when people say that.
I mean, I find it fascinating with some of the words you say.
It's okay.
I can't even quite think of Lucy. It wasn't Loosey Goosey. It was
No Fuss Gus. Yeah. I like to say peace out Girl Scout.
Oh yeah, I do say that too.
Yeah.
Once in a while, not all that often, but
yeah. Hasta la pasta.
Oh my God, that's an oldie.
I told you about that. I'm a young grandma. I'm not physically a grandma, but I have grandma tendencies.
I know. You're in bed by
8:30. Yeah. Yeah. So you got hasta la pasta. Yeah.
Hasta la pasta, baby.
Mm-hmm. Yeah. No, the baby is hasta la vista, not hasta la pasta.
So then maybe I've never used it. And I don't really use hasta la vista either. That
I don't think anybody does. Whoever.
I don't think I've ever used it even as my way younger years.
Yeah. I do say peace out Girl Scout though. I don't know why, but
see you later, alligator.
Yeah, well, that's a typical one. That's actually like a huge poem. That's got like 26 lines. Yeah, and it goes down like every single letter in the alphabet.
Huh. Yeah. I did not know that.
It's very extreme. All I know is the actual wild crocodile, and then it just goes on from there. Quite intense. But I have one that is not linked to mortgage, but I feel like it's very important for anybody in business or just in general, is Apple.
Oh gosh.
Versus Samsung. I, however, have an Apple, which I find to be far more superior than Samsung. But this seems to be like a hot bug, because I know that you and I talked about this one time before about voicemails and how you have sometimes your voicemail doesn't cooperate.
Yeah.
Because it's Samsung.
And that no.
Yeah, because you got to type in a PIN code and do all this stuff, and I can read my voicemail. So if somebody leaves me a voicemail, like if I'm in the middle and I can't answer and they leave me a voicemail, I can read their voicemail. It transcribes it live for me. Sometimes the words may be wrong, but funny.
It has nothing to do with the phone type. Why?
I think it does.
No.
No, is it user error?
No. Not at all. That's why on my voicemail, just to be safe, I'm always like, leave me a message or shoot me a text.
It should say, I have a Samsung, please text me. I won't get your voicemail.
It's not just because it's Samsung, smarty pants.
I think it is. I don't know. Samsungs are like foreign to me. My parents had Samsungs. And I'm like, I can't help you with that. That's too foreign. Like, I like my iPhone.
You iPhone users think you're like way up here.
It's because we are.
No, you're not. My Samsung works perfectly fine. And I'm very happy to give you Apple users green bubbles.
I am glad, though, that now, like, when people have Samsung, if they have this feature turned on, you can see when they read your messages. Now we can see that on Apple, because before you couldn't. Now you can see if people read your message, and you can see like a little green bubble, like if they're typing back. So at least they have like synced themselves together in that regard. And the chargers on the new iPhones are the same as the Samsung chargers.
Wow, I wonder why they're the same as Samsung. Probably because there's a lot more Samsung users.
No, probably because Samsung doesn't want to change their ways, and Apple wants to show them how advanced they are and that they are capable of change. While Samsung stays, where they are. So we're just constantly evolving. I'm just saying.
Well, at least I don't have to pay for my apps.
I don't have to pay for my apps either.
Yes, you do.
No, I don't.
You have to, yeah. Apple, when you go to your little Apple store.
False.
Okay, whatever.
I mean, there are certain ads you got to pay for in general, like some of those game apps and stuff. Or like if I have GoodNotes on my phone, you have to pay like an annual subscription for GoodNotes, but that's for across the board. That's not.
I swear there's some. Pretty sure there's some.
Denied.
Whatever.
Tell us in the comments what your guys' thoughts are, because I feel like we're very divided when it comes to Samsung versus Apple. And I know in our BNI group, there used to be somebody in there for US Sailor, and she would talk about it. Like, it's not the whole group is, battle it out together, because I feel like people are going to die on their hill. Whatever hill they choose, that's where they're going to stay. Most people, I feel like, don't convert from one to the other. I feel like they stay where they are.
Or they do convert over to Apple and they come right back to Samsung.
No.
No. True. So yeah, comment whether you like Samsung or Apple better.
Yeah, so they do the same thing. They help with communication. However, they're two very different things. Where are my Apple lovers in the group? I know there's a lot of them. We got quite the army of people.
So do Samsung users. Pretty sure you're outnumbered in this office.
Well, that's not fair.
Just saying.
That is true. That is true. But yeah.
Yeah, I think that's all we have.
I think it's a great way to end this segment.
I think so too.
Yeah, Apple versus Samsung.
I really hope there's a lot of Samsung comments. I hope to blow you out of the water.
Yeah, we'll take a poll. We'll have a poll put up, and we'll see. We'll see which one wins.
I mean, and who knows? Maybe Samsung users just don't want to brag and put it all out there.
Oh, but they do. I feel like anybody who likes to brag about something. All right, well, that's all we got for you guys today. Thanks for tuning in, and we'll see you next week.
Yep. Bye.